Welcome back to the FT series on market bubbles. When it comes to the world's safest government bond markets, it's a matter of how low can you go. Yields have fallen on US Treasuries, UK gilts, German Bunds and Japanese government bonds. Indeed, yields on German Bunds have fallen to the lowest for 2 centuries. Yields, which move inversely with prices, have fallen to such a level that investors must worry if there's a bubble and if there's a correction, whether they'll get burnt. With me to discuss why yields have fallen so far and whether there are dangers ahead is Stephen Cohen, who's a fixed income strategist at BlackRock. Welcome, Stephen. If we look at our first chart, we can see how yields have fallen during the crisis years, but also if we see 2014, they were falling in the US and the UK, even though economies were recovering. Can you explain that?
Yeah, I think what's happened this year is a number of factors. One is that the data has clearly been quite mixed, the economic data. And secondly, central banks continue broadly to be quite dovish in their rhetoric, led by the ECB with their actions, but also both the Fed and the Bank of England.
We expect the Fed to keep rates low for a long time, even though they're winding down the quantitative easing program.
Well, I think the big question for the Fed post-October, when tapering completes, is when do they raise rates? And to that extent, so far, they've been very, very dovish. But that does raise some questions as the data potentially picks up later in the year. What actually should be the exit policy for the Fed?
There's also geopolitics going on as well. We've got crises going on in Ukraine and the Middle East as well. Has that played a role this year as well, do you think?
I think it has played a role to an extent because clearly government bonds have benefited from an element of a safe haven bid, particularly Bunds, and you mentioned Bund yields being so low historically.
In Germany as a refuge for investors.
Absolutely.
Okay, so the question now, of course, is what happens next? What happens for the rest of this year and for subsequent years? Are we going to see a sudden correction in yields, do you think, on these government bonds?
Well, I think imminently, no. Our view is that we're moving to a point where central banks start to diverge. So on one hand, you have the Bank of England and the Federal Reserve, who are thinking about their exit strategy. On the other hand, you have the ECB, the European Central Bank, and the Bank of Japan, who are thinking about potentially more accommodative policy. The potential risk is more in the first camp, led in our view, absolutely led in our view by the Bank of England, where we think the gilts market is the most vulnerable. For the Federal Reserve, I think the key really is going to be about the labour market and this question about how much real slack is there in the labour market.
Now, if we look at the pattern in previous years, of course, there's been quite a strong correlation between certainly German and US yields. Will that break up, do you think, if we get this divergence?
Well, I think what we have seen so far this year is there has been some divergence between US yields and German Bund yields. They've gone in roughly the same direction, but they have diverged in terms of the spread between them. We expect that to continue, but clearly if we were to see any sort of major shift in the US Treasury market, that would have an impact on the German bond market as well.
Is this process going to be manageable? Do you expect a big pickup in US yields, a sort of pickup that's going to be destabilising for the global economy?
When we look out this year, the answer is no. I think the real threat or the pressure will be more in the intermediate 5-year part of the US yield curve. But clearly risk assets have had a very long rally this year. So there is some sense that potentially if the Fed does change its rhetoric and become a little bit more hawkish, that could have a negative impact more broadly in risk assets.
Okay, now our second chart is looking at inflation rate, which of course is crucial for central banks in setting interest rates. The consensus, at least the forecast we have here from the IMF, suggests that the low rates we've been having recently are going to continue. That's presumably going to be a factor keeping a lid on rates.
Well, I think one of the realities of the current world is there's very limited inflation, and nowhere do we see that more in the case of Europe, where inflation is 0.4, 0.5%. And I definitely think in the Eurozone, we're not really going to see any pressure on inflation. In the US, potentially we may start to see a little bit of wage pressure. I think that is the real key to watch for us.
And Japan, of course, we've seen a very aggressive action by the Bank of Japan there. Yields really rock bottom. Can they even go lower?
Never say never in Japan with Japanese government bond yields. I think the key is what does the BOJ, the Bank of Japan, do next? Because I think the Bank of Japan has intimated that it's done enough. Our view is that CPI inflation in Japan is not going to hit the Bank of Japan's target of 2%, and ultimately, if maybe not this year, but definitely next year, the Bank of Japan will need to do more, and that continues to support long end, especially Japanese government bonds.
Stephen, thank you very much. So the outlook there, not too worrying for investors. We may see some divergence between Germany and Japan, US and UK if BlackRock's correct, but the correction in US perhaps not as striking as some people might fear.